President Trump's tariff policies are rapidly accelerating the global de-dollarization trend. What does that mean? It means countries around the world are slowly stepping away from the US dollar and its influence on the global financial system. This shift won't happen overnight, but it's already in motion, and Trump's trade war has only made it move faster. These tariffs have sparked a serious crisis of confidence in the US dollar. Let me explain what happened just last week. As many of you know, Trump's announcement of reciprocal tariffs caused the stock market to plunge. Now, typically when investors panic, they flee to safety, usually buying US treasuries and strengthening the dollar. But this time, that didn't happen. The co-founder of BlackRock, who pointed out how unusual this is. Normally in a downturn, investors seek quality, meaning treasuries and the dollar. But in this case, treasury yields rose and the dollar weakened. That's a red flag. Something deeper is happening here beyond the usual market corrections. Now people are asking a serious question. Is the US dollar still the world's reserve currency? The answer is yes, but it's losing ground. Take a look at the data. The dollar's share of global reserves has steadily dropped, from 72% 25 years ago to just 58% now, and it's not slowing down. But here's the key point. The dollar isn't being replaced by one currency like the euro or the Chinese yuan. In fact, the euro's share has dropped from 28% in 2009 to around 20% today. And the Chinese yuan hasn't taken over either. So where's the dollar's share going? To multiple currencies. The Japanese yen, British pound, Canadian and Australian dollars, Chinese yuan, Swiss franc. They've all been gaining small portions. That light blue line on the reserve chart, that's a basket of currencies. The world isn't replacing the dollar with one alternative, it's diversifying away from it. Someone should probably explain this to Treasury Secretary Scott Bent. He's been saying there's no risk because the dollar isn't being replaced by the yuan. But that's missing the bigger picture. In fact, let me show you this clip. When asked about the dollar's reserve status, Scott dismissed the concern, saying the yuan isn't a reliable reserve asset. Maybe not. But again, that's not the point. The dollar is slipping because confidence is fading, not because a rival currency is winning. The US has long benefited from its reserve currency status. It gets to borrow money more cheaply because the world trusts the dollar and the US government. That trust allows lower interest rates and what economists call an exorbitant privilege, meaning the US can consume more than it produces without a collapse in its currency. This status also gives the US geopolitical power, like enforcing economic sanctions. But these privileges are at risk because the world is watching America rack up trillions in debt, and the Federal Reserve keeps printing money to cover government overspending. The US is running a 7% deficit when it should be closer to 3%. And on top of that, Trump's aggressive tariff policies are straining relationships with allies. The result? More countries are walking away from the dollar. De-dollarization is real, and it's accelerating. Let's recap. After Trump's tariffs, it wasn't just the stock market that suffered. The bond market had one of its worst weeks in decades. When bond prices drop, yields rise, meaning interest rates go up. And we haven't seen this kind of sharp interest rate jump since 1982. It's not that rates are at their highest level ever, it's how fast they're rising. That's the concern. Higher rates impact mortgage interest borrowing costs and slow down the stock market. The bond market's sell-off spooked investors. Trump clearly saw what was happening. He paused tariffs for 90 days. But he claimed it wasn't related to the bond market crash. In this clip, when asked whether the bond market influenced his decision, he deflected, calling the bond market beautiful. But behind the scenes, it was clear. Confidence was cracking. Even Treasury Secretary Scott Bent said the 90-day pause had nothing to do with the bond crisis. But ask yourself, do you believe that? Let me break it down simply. If a foreign country wants to trade with the US, they need dollars. But they don't hold cash, they buy US treasuries. Now, if tariffs reduce trade, they need fewer dollars. That leads them to sell treasuries, which pushes prices down and interest rates up. That's exactly what's happening. As Deutsche Bank's currency strategist George Cavellos put it, the market is reassessing the structural attractiveness of the US dollar. We're witnessing a process of rapid de-dollarization. So what can you do? Here's what I'm doing, and it's simple. Diversify. I've said this for years. Buy gold and silver. I invest in both. I prefer silver, but I own gold too. You can invest in physical metals or use stock tickers, GLD for gold, SLV for silver. These precious metals are expected to perform well as de-dollarization grows, but don't treat this like a short-term play. This is a long-term strategy. Thanks for watching. If you found this helpful, please subscribe for more updates on the evolving global economy. Stay smart, stay diversified.